You've heard it before: invest early, let your money compound, time in the market beats timing the market. And yet, when you actually look at the numbers in your own account, it can feel underwhelming. You put in $200, it grows to $214, a year later, maybe $230. It doesn't feel life-changing, it feels slow, almost pointless. That feeling is normal. Compounding is powerful, but it's not exciting in the beginning. It's quiet, subtle, easy to underestimate. The early years look like nothing is happening, the later years look like magic. To make this real, I want to show you a simple mental model, the 5th of October 25 rule. It's not a technical formula. It's a practical way to understand how compounding actually behaves over time and why the early years matter more than they seem. Once you see it clearly, compounding stops feeling pointless and starts feeling inevitable. Why compounding feels so slow at first? Let's start with the emotional side. If you invest $10,000 and earn 8% in a year, you make $800. That's nice, but it's not dramatic. The next year, you earn 8% again. Now you're earning 8% on $10,800. That's $864. You made an extra $64 compared to the year before. That difference doesn't feel meaningful. But here's what's really happening. Year 1, $10,000, right pointing arrow, $10,800. Year 2, $10,800, right pointing arrow, $11,664. Year 3, $11,664, right pointing arrow, $12,597. The gains are growing each year, even if you don't notice it. The problem is psychological. Humans are linear thinkers, we expect straight lines. Compounding is exponential, it curves upward slowly, then suddenly sharply. In the early phase, the curve looks flat, that's where most people give up. The 5th of October 25 rule explained. Here's the core idea. If you invest consistently and earn a reasonable long-term return, let's use 7 to 8% as a rough example. Compounding tends to break down into 3 phases. The first 5 years feel almost pointless. Around 10 years, it finally feels real. Around 25 years, it feels unstoppable. That's the 5th of October 25 rule. It's not about exact percentages, it's about phases of growth. Phase 1. The first 5 years, the invisible stage. In the first 5 years, most of your growth comes from what you contribute, not from returns. If you invest $500 per month for 5 years, that's $30,000 invested. Even at 8% annual growth, your balance might be somewhere around $36,000 to $38,000. You worked hard to put in $30,000, the market added maybe $6,000 to $8,000. It doesn't feel dramatic. In fact, if the market dips during that time, you might feel like you're barely moving forward at all. This is the stage where people say things like, "Is this even worth it? I could use this money now. Maybe I should try something faster." But what you don't see is that you're building the base, you're creating the principle that future compounding will multiply. The first 5 years are about habit and foundation. They are not about fireworks. Phase 2, 10 years, the turning point. Now let's extend the same example to 10 years. You invest $500 per month for a decade. That's $60,000 contributed. At 8%, your total balance might land somewhere near $90,000. Now something interesting happens. The growth portion is no longer small, the market may have contributed $30,000 or more. You start noticing years where your account grows by $6,000 or $7,000 without you increasing contributions. Some years, the growth alone equals what you put in. That's the turning point. This is when compounding stops feeling theoretical and starts feeling real. You look at your account and think, okay, this is actually doing something. Phase 3, 25 years, the acceleration phase. Now imagine you stay consistent for 25 years. You invest $500 per month for 25 years, that's $150,000 contributed. At 8%, your total could grow to roughly $450,000 or more. Look at that difference, you put in $150,000, compounding added around $300,000. Now the market is doing more than you ever did. In strong years, Your account might grow by $30,000 or $40,000 in a single year. That's more than your annual contributions. The snowball is now rolling on its own. This is why people who stay invested for decades look lucky. They're not lucky, they just survived the first 5 years. Why most people miss the 25-year outcome? The math isn't complicated. The behavior is, most people interrupt compounding. They stop investing during downturns, pull money out early, chase trends, restart repeatedly. Every interruption resets the curve. Compounding requires time without interference. That's harder than it sounds. When markets drop 20%, the 5-year investor panics. The 10-year investor hesitates, the 25-year investor understands it's part of the path. The difference isn't intelligence, it's time horizon. A closer look at the curve, here's a simple way to visualize it. Imagine your money as a tree. Year 1 to 5. You're watering a small sapling, it looks fragile, it barely grows, you wonder if it's worth the effort. Year 6 to 10. The trunk thickens, growth is visible, but it's still modest. Year 11 to 25. The roots are deep, the canopy spreads, growth compounds on itself. If you dig it up in year 4 because it isn't big enough, you never see what it becomes. Compounding punishes impatience, it rewards consistency. The hidden multiplier: reinvested gains. The real power of compounding isn't just earning returns, it's earning returns on your returns. In the early years, your returns are small, so the second layer of growth is tiny. By year 15 or 20, the second and third layers become significant. For example, if your portfolio earns $25,000 in a strong year and that amount stays invested, next year you're earning returns on that $25,000 too. That layering effect is invisible at first, but after decades, it's the main driver. What the 5th of October 25 rule teaches about starting late? You might be thinking, what if I'm already 40? Or 50? The principle still applies, the timeline may be shorter, but the phases remain the same. The first few years will feel slow, around year 10, momentum becomes visible. Even 15 years of uninterrupted compounding can create meaningful growth. The lesson is not, start at 20 or you're doomed. The lesson is, the earlier you start, the more of the acceleration phase you get. Time is the multiplier you can't replace. You can increase contributions, you can seek higher returns, but you can't manufacture decades. The emotional gap between effort and reward. One reason compounding feels pointless early on is the effort to reward mismatch. In the beginning, you sacrifice spending, you automate transfers, you track investments, you ignore market noise. And the visible reward is small. Later, the effort stays the same, but the reward grows dramatically. That gap flips. After 20+ years, you might invest $6,000 in a year and see your account grow by $35,000. Same effort, very different outcome. The 5th of October 25 rule helps you accept that the payoff is backloaded. What happens if you quit at year 5? Let's say you invest diligently for 5 years, then stop because it wasn't doing much. You might walk away with $35,000 to $40,000. But if you had kept going for 20 more years, that same habit could have built several $100,000. Quitting early doesn't just stop growth, it eliminates the most powerful phase. That's the tragedy of impatience, the compounding crossover point. There's a specific moment in long-term investing that changes everything. It's when your annual gains exceed your annual contributions. Before that point, you are the engine. After that point, your money becomes the engine. The 5th of October 25 rule suggests that crossover often happens somewhere between years 10 and 20, depending on contribution size and returns. Once you cross it, motivation changes. You no longer feel like you're pushing a rock uphill. You feel like you're steering something that already has momentum. Why small increases matter more than you think? Because compounding multiplies everything. Small improvements early have outsized long-term effects. Increasing your monthly investment from $500 to $600 doesn't feel dramatic. But over 25 years, that extra $100 per month can grow into tens of thousands of dollars. The earlier you increase contributions, the more layers of compounding they receive. It's like adding fuel at the beginning of a long flight instead of midair. The 5th of October 25 rule beyond money: compounding isn't just financial. It shows up in skills, health, relationships, and reputation. Practice a skill for 5 years and progress feels slow. Do it for 10 and people start noticing, do it for 25, and you're seen as exceptional. The curve is similar. Early effort, invisible gains, gradual momentum, then exponential improvement. Understanding this pattern changes how you approach long-term goals. You stop expecting immediate results, you focus on consistency instead. Practical steps to survive the first 5 years. Since the first 5 years are the hardest emotionally, design your system to get through them. Automate everything, remove the need for constant decisions, track contributions, not just returns, celebrate the habit. Avoid daily account checking, it magnifies short-term noise, increase contributions gradually, tie them to raises or bonuses. Study long-term charts, train your brain to think in decades. Your job in the early phase is simple, don't quit. A simple comparison, imagine 2 investors. Investor A invests for 5 years and stops. Investor B invests for 25 years consistently. The difference between them isn't intelligence or timing, it's endurance. Investor B experiences the acceleration phase, Investor A never does. That's it, the illusion of fast money. Part of the reason compounding feels boring is that fast money stories are loud. Day trading wins, crypto spikes, business exits, those stories are dramatic. Compounding is quiet, it doesn't produce viral screenshots. But over 25 years, steady compounding often beats inconsistent bursts of high-risk behavior. It's not flashy, it's reliable. What the 5th of October 25 rule really means, the rule isn't about exact numbers. It's about expectations. Expect the first 5 years to feel slow. Expect real momentum around 10 years. Expect serious acceleration by 25 years. If you align your expectations with reality, you won't feel disappointed, you'll feel patient, and patience is the price of exponential growth. The long view, then you zoom out far enough, compounding looks obvious. But when you're living inside year 3 or year 4, it feels subtle. The key is to understand which phase you're in. If you're in year 2 and frustrated, that's normal, you're in the invisible stage. If you're in year 9 and finally seeing traction, that's normal, you're near the turning point. If you're in year 20 and amazed at how much growth comes from the market itself, that's normal too, you've reached acceleration. The curve hasn't changed, your position on it has. Compounding doesn't feel powerful in the beginning because power hasn't had time to accumulate. The 5th of October 25 rule reminds you that growth is backloaded. The magic is delayed, most people quit before they reach it. If you can stay consistent long enough to move from 5 to 10 to 25 years, you don't need brilliance or perfect timing. You just need endurance. And once compounding crosses that invisible threshold, it no longer feels pointless, it feels inevitable. If compounding has ever felt slow, boring, or pointless, this is your reminder. You're probably just early in the curve. The 25105 rule shows that wealth doesn't explode overnight, it builds quietly. The first 5 years test your patience, 10 years builds belief, 25 years builds freedom. Most people quit during the invisible phase, the few who don't are the ones who later look lucky. If this video helped you see compounding differently, share it with someone who's in year 2 and feeling discouraged. And if you're already in year 10 or beyond, drop a comment with your experience. Your story might be the proof someone else needs to stay consistent. Stay patient, stay invested, let time do the heavy lifting.